A very pleasant good evening to one and all, and a hearty welcome to all of you who have joined us here this evening for the final discussion in the BCSI BARAIFA 2022 virtual discussion series. This evening, BCSI is once again very pleased and happy to welcome all of you to this discussion, as well as BARAIFA. As mentioned weekly, this is a part of our educational series, and certainly as we seek to engage our membership and certainly to provide information that is critical to you. And one such information is the issue and topic of financial planning. We discussed financial plan at the beginning. Last week, we discussed retirement, and today we'll be discussing estate planning. And for each session, we've had our esteemed panel presenters, Mr. Wayne Eiffel and Mr. Roderick Nurse, who've been doing a phenomenal job of breaking it down and providing us with critical information and really good tips. Also with us this evening, once again, is our lovely moderator, Ms. Chantal Reefer. And the next voice you will hear after I read her short bio for you is Ms. Reefer. I do wish that you will have an enjoyable session, and I certainly invite you to look out for more of BCSI's virtual discussions. We will have more coming up very soon at the end of this month. So without further ado, I wish to introduce Ms. Reefer to you. Now, Ms. Chantal Reefer for the past has been providing great value to clients as a financial advisor at Sagicor Life, Inc. She provides financial counseling for people throughout various stages of their life and helps them plan for their short-term needs and their long-term goals. She is absolutely dedicated to the financial well-being of her clients and focuses on offering suggestions and alternatives on ways to help accumulate, protect, and preserve their ever-changing needs and priorities. Her educational background provides experience in government political studies, economics, and law. This background has influenced her transition into the advisory role, where she has helped corporate and individual clients identify insurance and investment needs that would benefit their individuals. She has been recognized for various accomplishments, such as being a Barbados Production Roundtable and Quality Awardee, an Inner Circle Awardee, Sagittarius Honor Roll, and a $1 Million Roundtable qualifier and attendee. Mrs. Reefer is a business owner in the field of real estate. She has written articles for the Nation's Work and Wealth magazine, covering topics such as entrepreneurship and finances. She is an avid food lover who enjoys various types of cuisines. In her spare time, she enjoys yoga, the beach, and time with her family. And without further ado, I wish to introduce you to Ms. Chantal Reefer.
Thank you so much, Alicia. Good evening, ladies and gentlemen. Welcome to part 3 and the final part in our virtual discussion series hosted by the Barbados Coalition of Service Industries in collaboration with the Barbados Association of Insurance and Financial Advisors. Today, we will be discussing the topic of estate planning. Now, BCSI is a national umbrella body that brings together all service sector organizations and associations. One of their main objectives and activities focus on education and awareness on topics such as today's topic. BARAIFA is a national and professional organization dedicated to educating and serving our community in areas of insurance and financial planning matters. The BARAIFA Institute is responsible for the development of programs for public education. Ladies and gentlemen, we have 2 presenters, as Alicia said. Our first presenter this evening is Mr. Wayne Eiffel, and our second presenter is Mr. Roderick Nurse. Now, Mr. Wayne Eiffel is the founder and managing advisor of Vanilla Financial Architecture, Inc., a Barbadian independent financial planning practice that specializes in providing personal financial planning advice, as well as mortgage and insurance brokerage services. He is a member of the Personal Finance Society, the Chartered Insurance Institute, the Society of Mortgage Professionals, and the Society of Insurance Broking, all in the UK, as well as the Barbados Association of Insurance and Financial Advisors. As a member of BARAIFA, Wayne has served on the bylaws and legislation, education, business standards and conservation, membership and programs committees. Wayne is also the creator of the M is for Money Barbadian Personal Finance podcast, where for the benefit of Bajans and permanent residents alike, using plain and simple language, he discusses and explains what you need to know and what you need to do when it comes to personal finance, mortgages, investing, insurance, pensions, retirement, and beyond so that you can make the most of your money. Outside of work, Wayne has lived in St. Vincent as a community service volunteer, and for the last 18 years, he has been involved with the deaf community in Barbados, both as an educator and a sign language interpreter. Ladies and gentlemen, let's welcome our first presenter, Mr. Wayne Eiffel. Wayne, you're a little low. I'm not sure we're hearing you very well. You're still low. I'm not sure what changed. Still very, very low.
How about now? Is it any better?
Yes, much better. Thank you. You just went right back down, Wayne.
Is it better now?
Yes, it is. No. No, no.
Is it better now?
Yes, it is. It went when it went right back down. I'm not sure if it is the what you're using. It doesn't have any cables. I don't know if you want. Is it possible for you to disconnect from your microphone? I think we might be hearing you. Can you say something? Oh, you're still very low. Do you want, I think we may need to start with Roderick. I can't hear you at all now.
How does this sound?
I can hear you now.
Okay, that's another microphone.
Okay.
All right, so sorry about that, everyone. Yes, so the last 2 weeks, we talked about the importance of financial planning for your lifestyle now and your standard of living now, as well as in the future. And then we talked about retirement planning so that you can live on your own terms after working full time. Tonight, I'll just spend a few minutes talking about estate planning. Now, we understand that for most people, they don't want to talk about death or what happens if they're unable to speak for themselves. However, I just want to put you at ease. You can rest assured that having a discussion about estate planning will not hasten that time, but it can pave the way for you leaving a positive legacy instead of chaos. So let's for a few minutes then talk about estate planning. Perhaps it's best to talk a little bit or to give you an example of what happens when you do plan and when you don't plan. So here's an example of one person. This is Jenny's story. Jenny's 32 years old and the only child of single mother, Barbara. Now, Jenny knows who her father is because she's seen his name on her birth certificate, and they would talk on and off over the years. But up until now, he has been unwilling or unable to support her financially, emotionally, or otherwise. In fact, the last time they spoke was around 10 years ago when Jenny needed help with UA expenses. Again, he was no help. So it has just been Jenny and her mother for the most part, and her best friend Sarah, who she met in secondary school, going through the ups and downs of life.
Wayne, are you showing a presentation? Because I'm just seeing Jenny's story on the
Now, where is
screen.
that coming from? All right. I'm sorry, I just heard a lot of feedback on my end. I don't know if you heard it. Right, so I'm just going to tell you Jenny's story. There are no pictures attached, so just listen to the story. Hope you've followed so far. Can everybody still hear me?
Yes, we can.
Okay, I'm sorry. Okay. So it's just been Jenny and her mother for the most part, and their best friend Sarah. They met in secondary school, and they've been through everything together. Now Jenny leaves UE, gets a job that allows her to support herself and her mother. After all, her mother made all those sacrifices for her growing up. Now, in fact, Jenny has just finished off paying for her car last year, and she and her mother have just moved into a house that Jenny has bought for the two of them. In fact, they're planning to have a few friends over to celebrate, their new house. Now, during the process of applying for the mortgage, Jenny had to buy life insurance to cover the $300,000 mortgage. So she decided to buy $500,000 worth of life cover so that her mother would not have to worry about losing her home, and also have some funds to support her if Jenny died before her. Jenny's financial planner advised that she consider her wishes and have a will prepared to reflect those wishes. Jenny said, "I'm young. I don't have any children, and my mother knows that the house is for her, and Sarah knows that she can already have my jewelry and shoes. After all, she wears them more than I do now anyway." So Jenny puts off having a will. The day of the party, Jenny's out with Sarah getting ice when they're involved in a horrible accident and Jenny dies. Tragic, certainly. But for the purposes of our discussion, here's the question. What happens to Jenny's estate? And by estate, and please understand that whether you have a will or not, you have an estate. What is your estate? Your estate, the things you own and control, make up your estate. So, what do we know about Jenny's estate? Well, we know Jenny has a car that's free and clear because she's paid off for it. She mentioned jewelry and clothes to her financial planner that Sarah was going to get. We know because she has life insurance, because of the mortgage, at her death, the life insurance will pay off the remaining balance on the mortgage, about $300,000 because it's a brand new mortgage, which leaves another $200,000 in cash as proceeds for life insurance policy in her estate. And then her estate includes all the other things that she owns. So the question is, what happens to Jenny's estate, to these things that she owns? If you would say that Jenny's mother gets to keep the house and Sarah gets to keep the jewelry and clothes, you'll be partially correct. And in some cases, you'll be totally wrong. Let's explain. According to the laws of the land, a single person dying without children and without having a will is called being intestate. The law has already decided who gets what. And for that person's estate, in this case, Jenny's estate, both of her parents will share equally in all that she owns and controls. So that car, half of it belongs to her father. That house, half of it belongs to her father. The father who was either unwilling or unable to support her all these years. In fact, if the father demanded his half share of that house, and Jenny's mother was unable to come up with that $150,000, she might be forced to sell that house. The very thing that Jenny did not want to happen. As for all the other things, the jewelry, the clothes, and all those things, part of her estate to be shared equally between both of her living parents. Now, you might be saying, I gave you 2 horror stories. In fact, when I described my client's situation, she was a single woman with no children, explaining that she'd be practically in the same situation as Jenny. She started to swear. But that is the reality of not having a will. If you do not have a will, the law has already decided what happens to the things that you own. If you want to have some say in what happens to your stuff at your death, you need to have a will. Now, the question is, what does estate planning involve? 2 things. The things you own and control and how you want them to be used for the people and things you care about. You might have particular causes, for example, that you wish to donate to at your death. So this is what an estate planner is concerned with, how to make these things happen. And to make it simple then, an estate plan, a comprehensive estate plan should answer these 4 questions. Question number 1. If you're unable to physically get around, who do you wish to conduct your financial affairs? Question number 2. Should you need medical treatment and be unable to speak for yourself, for example, you're in a coma, who do you wish to make those decisions for you? Are there any treatments or procedures that you definitely do not want? Who do you trust to make sure that your wishes are respected? How long do you want to be kept alive by machines if there's little or no hope of recovery to a meaningful life? Who do you trust to look after your financial affairs while you're unable to? So those are some of the questions that arise under those circumstances. Question number 3. Should you become mentally incapable of managing your affairs, who do you wish to manage them for you? So who would you want to manage your financial affairs? Who would you want to make decisions about your medical care? Who would you want to raise your children? Those are all associated questions if you find yourself in this particular situation. And then upon your death, what are your wishes? Does your spouse or family know where to find your important documents, online accounts and passwords, including social media? Who would you wish to raise your children? How would you like your assets to be distributed? Do you wish to make financial provisions for your parents if they're still living? So those 4 questions are at the heart of a comprehensive estate plan for individuals. Roderick will talk about individuals who happen to be business owners as well. There are additional considerations if you are in that category. So your estate planning team is your financial planner, whose goal is to make sure that your wishes are financially possible. Another member of your team is your attorney, and his goal is to make sure that your wishes are legally possible. And in some cases, you will also require your accountant to be part of this team to come up with this plan for your estate. You can see here from this comprehensive view that estate planning isn't just about death. It encompasses if you are mentally incompetent, if you are physically unable to get around, or if you are unconscious. And those first three, you will have to have in-depth discussions with your attorney. Usually the part that involves financial planners is when it comes to point number 4, what they want to happen upon your death. Right, so let's give an example of how this team works. Say you're a parent and you're concerned for your minor children in the event of your death. Here are some of the questions that need to be considered and to have definite answers to. Where will they live? Who will raise them? How much will it cost to raise them in the manner you desire? And who will control the money and under what conditions? To answer those questions, your financial planner should be able to calculate the funds required. Remember from last week's discussion, we learned that inflation is one of those things when it comes to money in the future, you have to be very careful in calculating. It's not something about just pulling a number out of the air. So your financial planner should be able to calculate the funds required. And then there are other considerations. For example, if you have hard assets like a house, do you wish that house to be kept for the inheritance of your children when they get older? Or are you willing to sell it and have the money be used for their upkeep and upbringing? Or perhaps do you want to have it rented out to help support your children while they're growing, and when they reach of age, that property can be transferred to them? The answers to those questions affect how much actual hard cash you need to leave behind for your children. When it comes to who will raise them, Barbados is one of those countries where in your will, you can state who you want to take on your parental rights. So you can name the person or persons that you're giving your parental rights to in your will. So in the case where a child has 2 living parents and one of them dies, the one who died could, in their will, name the person or persons that they're giving their personal rights to. The surviving parent will clearly continue to have their own parental rights. Now, another thing that is useful, because in Barbados, again, a person under the age of 18 cannot inherit property. So you cannot very well leave large sums of money or a house or anything of that nature to a child. But then there's an inherent danger in leaving it to someone else, even if there's some sort of understanding. Oftentimes, in face with this reality, clients will say, well, I'll leave the proceeds of my life insurance policy, for example, to my sister. My sister has children of her own. We already talked about this. If I die, she will raise my children. So here's the inherent danger of that. So you'll name your sister as beneficiary, you die. Your sister inherits this large sum of money for the use of raising your children. And your sister loves your children, her nieces and nephews, and she will absolutely do that. But perchance, suppose your sister died while your children were still young. What happened to that money? Well, it became part of her estate, because from the time she inherited, it became part of her estate. Now, suppose she died without a will, and she was married and had children. Everything that is in her estate will now be passed on to her children and her husband. Now, her husband might be an honorable man and decide, well, I know this money legally is mine, but I know what it's for, and I'm going to use it to raise these children. Or he could be a person who says, I'm so distraught because of the loss of my wife, I can barely hold it together. I will take care of my own children. As far as these other children, I never wanted them here in the first place. They're not related to me. The court has to find somewhere for them to live. And somehow he forgets about this money, and that is now his, and he uses it. If you don't want to take chances with your children and their upbringing, supposing if you died while they were so small, having a will that names the guardians of these children and having a trust where this money is held in trust by trustees for your children's benefit, then this is something you should definitely think about. A trust allows the money to transfer not to your minor children, but to a trust with trustees. Those trustees have a legal responsibility to use that money for the benefit of your children. If the trustees and the guardians are two different groups of people, they can both keep an eye on one another. So that's something you'll have discussions with your attorney about. What your financial planner will do is guide and advise your trustees, because all of a sudden you might have 2 or 3 people that are now responsible for $500,000 for raising these 2 children, and they might have concerns. Are we going to waste the money? How much money should we give each month or each year to the guardians? And the rest of the money, what are we supposed to do with it? There are a number of questions that they might have, and guidance would be useful, because as well-meaning as they are, they might not have experience taking care of money for the benefit of others. Your financial planner will also advise on how to make sure that the right amount of money is available to the right people when the time comes. In Barbados, there are no estate taxes, there are no inheritance taxes. However, whenever there's a will, there will be legal fees, and there will be other fees paid to the government, fees and taxes. In fact, if you go around Barbados, you see a lot of houses and properties falling apart. Very often, it's a situation where this estate, there was no money available in this estate to take care of those necessary expenses to have that estate settled. So a financial planner's role is to look at your entire estate plan, figure out how much money is likely to be needed, and how to make that money available at the right time in the right person's hands. You may know that legal fees when it comes to administering and distributing estates are based on a percentage of the value of the estate. So the greater the value, the greater the legal fees, and then there are additional fees as well. So this is how an estate plan, the different areas that are considered for an individual are drawn up. Clearly, as your situation changes, you might need to make additional changes to your estate plan. You might have an additional child since you had your first estate plan drawn up. You might now have to take care of your parents. So there are situations that can cause adjustments to your estate plan. Now, one of the things that is inescapable, that whenever someone dies, and that person leaves people behind that depend on them financially, one of the things that's required is money. Assets are great, but assets take a while to take into cash, and sometimes you can't turn them into cash. For example, the family home might be free and clear, but you can't very well break off a piece of it and convert it into cash. So one of the other professionals that normally comes into this picture are insurance professionals, because insurance policies are one thing that can stand outside of your estate. So say you had a number of assets, but you have a number of debts as well. Your assets have to take care of your debts, and if anything is left, then your beneficiaries will inherit. However, insurance policies have the ability to stand outside of your estate. You can have a life insurance policy that names a beneficiary. That beneficiary could be a person, it could be a trustee, but that money that's payable on your death does not form part of your estate. It does not form part of the amount that informs your legal fees. It is not exposed to creditors, but it can just be pure cash that is made available for the benefit of your dependents, whoever they may be. So there are a number of other considerations when it comes to estate planning, but it depends on your individual circumstance. Actually, in putting together this presentation, I had a little difficulty because there are a number of other considerations, and usually those considerations are guided by the individual that I'm working for and their particular needs and wishes. But I think we've covered the basic questions that need to be answered by an estate plan, as well as how we can address those concerns. At this point, if you have any questions, I'll be happy to try to answer them.
Thank you very much, Wayne. That was a very excellent presentation, very insightful. We have a couple of questions here. Can life insurance provide money to settle the estate if there is no money?
Yes and no. Here's a curious thing about the Insurance Act in Barbados. And it's one of those things, I don't know if, well, I've spoken to some attorneys and they weren't aware until somebody made them aware. So you can have a life insurance policy and you can name estate as a beneficiary. And that money now goes into your estate. But the Insurance Act in Barbados actually says that the proceeds of a life insurance policy cannot be used to settle debts, even if those debts are ordered by the court, unless the person who died expressly said in their will, the proceeds of this life insurance policy with this company and this policy number shall be used to settle my debts. Now, the challenge is, the interesting thing is, suppose you die and your attorney, the attorney who's settling your estate, your wife or whoever the executor was, hires this attorney to go through the process of administering and distributing the estate. Suppose your attorney was not aware of that provision in the Insurance Act and just sees this money that's in the estate and he sees these debts and he starts paying them out of the proceeds of the life insurance policy. That can very well happen. Here's another reason why you should have a team when it comes to your estate planning. Your attorney provides a valuable service, but your financial planner also provides a valuable service and can, in some cases, save your beneficiaries from losing money to creditors.
Okay, thank you so much, Wayne. Okay, so another question, if there's no money to settle an estate, what happens?
Oh, so let's say this up front. Financial planners like Roger and myself are not attorneys, but if you're giving financial advice and it touches, and we are bound by the laws of the land. So we must be aware of the laws of the land. So I don't want to give you the impression that I'm going to give you give you legal advice in this forum. I'm not. If you have legal questions, they're best addressed to your attorney.
All right, thank you. Okay, my parents never discussed estate planning with me. How do I break the ice?
First of all, assure them that having this discussion will not hasten their death, and that is not why you're doing it. Everybody in Barbados who reads newspapers know how people behave when it comes to estate matters. People have killed siblings over estate matters. If you don't want to leave chaos behind, it's best to have a discussion with your family and your attorney and your financial planner to come up with a plan that allows your wishes to be carried out for the benefit of your loved ones. So you might have that discussion by saying, well, we know that you love us and we love you, but things happen. And I could die before you, or you could die before us. If I die before you, I know I have certain wishes, like I've put down in writing for your benefit. I'm not saying I want you to give me everything that you own, but I suggest that you at least give thought to how you want your assets to be distributed and have that put down in writing. That way, you will have the peace of mind of knowing what will happen, and there will be no confusion or chaos when the time comes when you are no longer with us.
Okay, would you say then that accumulation is a definite stage in estate planning? Cash
Yes.
accumulation.
During our lifetime, we will accumulate things. House, car, personal belongings, cash, other assets. Whether we say something or not, those assets will be distributed on our death. As the saying goes, we can't take it with us. But after we accumulated those assets, we get to say how we want them to be distributed at our death. We might very well use them during our lifetime, but at our death, we can have a say in how we want them to distribute it. So we accumulate while we are working. We enjoy those accumulations or draw down on them during retirement, and at our death, those accumulated assets will be distributed. You get to say if you want to have a say in how they distribute it or not, by having a will or not having a will. Remember, Jenny.
All right. I am not wealthy. Why do I need to have an estate plan?
It's not about wealth per se. It's about having a say about your things. And remember, an estate plan isn't just about things. An estate plan can allow you to have a say on what happens to you if you're unconscious. What happens to you and your children if you become mentally incompetent through the illness or accident. You get to say who will raise your children. You get to say if there's some medical procedures you don't want to undergo. So just don't think about the money, think about the entire estate plan. If there's money, you get to say how it's to be used. If you don't say, it might be used in a manner that you don't want.
Okay. All right. And can you repeat the role of a trust in estate planning?
So a trust is made up of three parties: the settlor, the person who puts money or assets into trust; the trustees, whose responsibility is to administer those assets for the benefit of the third group, the beneficiaries. So the trustees don't legally own the assets. They're legally responsible for using those assets for the benefits of the trustees. So you have a 5-year-old and 12-year-old, they can't inherit property. You and your lawyers sit down and draw up a trust where it says these assets, the proceeds of this life insurance policy, the other assets that I have are to be used for the benefit of my children, age 5 and age 12, until they reach age 21. At age 21, the trustees are to turn over the assets to my two children. And you can put in any conditions you want. And the trustees will be legally bound to them. And if there's the guardians or somebody else, the guardians can, if they suspect that the trustees are not acting in the best interest of the children, can actually draw that to the attention of the court. And the court, usually in any case, will require that trustees report in an annual basis on how they're administering the trust. So a trust is a legal arrangement where property is transferred for the benefit of others, but controlled by someone else.
Okay. All right. Thank you so much, Wayne. We learned a lot this evening from you. If we have any more questions, and if you guys have any more questions, be sure to place them in the chat, and after our second presentation, we can be sure to ask the remainder of questions. So let's welcome our second presenter this evening, Mr. Roderick Nurse. Mr. Nurse will be presenting on estate planning for businesses. Okay, Roderick Nurse joined Sagicor in 2008 and works as an insurance sales advisor. He transitioned to the financial services sector, having spent approximately 20 years in the information technology arena and the latter 5 years as a small business owner. He is a qualified financial services specialist and is the chairman of the BARAIFA Institute. He holds the designations of LUTCF, which is the Life Underwriting Trainer Council Fellow, FSS, Financial Services Specialist, and the CLU, which is a Chartered Life Underwriter. Throughout his tenure, he has served on the board of directors of BARAIFA, its educational committee, and was also chairman of the Bylaws and Legislation Committee. Outside of work, he is the vice president of BFFRA, which is the Barbadian Families and Friends Relocation Association, with the responsibility of training and development, dealing with some of the projects which include the care of the elderly and caregiver community program, managing money for secondary school teams, and the primary school stationary aid program. In addition, he volunteers with Parados as a facilitator of the financial planning module of their parenting class, as well as serves on its board of directors. Ladies and gentlemen, let's welcome Mr. Roderick Nurse. Good evening, Roderick.
Hey, good evening. It is good to be here. I'm going to do my usual stuff. Let's start this presentation. Sorry. I'm about to share the screen, and an interesting thing happened that I hope it does not reoccur, where on both devices I have up, I actually lost internet connection, and they came back up and it was restored. So I am really hoping that that was the plan and I will only have one dropout tonight, this evening, and we will be able to get through this. We touched on some areas when it comes to financial planning, and I'm going to look at the micro and family-owned business. Kind of a review where financial planning falls in the scheme of things. Let me get my pointer. Even though it is here, one of the things I make mention of, and it is an important part of the whole financial planning process. I normally compare this with retirement planning. While retirement planning has a particular age, you know what you are aiming for, the time where you want to stop working. If you're employed for the business, let me add here, for the business person who is enjoying the job, or self-employed or family-owned business, there's no retirement age. In fact, there's really not a retirement age, and I think that came about where people were saying that businesses need to adjust their retirement age in light of government, but you discovered that is not the case. And if we were also did a little more convincing, we had Prince Charles taking up a job as king at age 73. So no, there's not a retirement age. Estate planning is a process that can occur at any stage in life, and I think it is something that we must be ready for. The three areas that we touched on over the past couple of weeks mimic the estate planning process, where the first part, where we were looking at the starting of a business and things like that, mimics the whole idea of the creation of the estate. This will also be relevant for the person when they start to work, in that a person is acquiring assets, acquiring items from the clothes you buy, the house, the car, the land, all of these things that have value are part of the estate. And let me also say that the debt that you have is also part of the estate as well. That does not die with the person. But the business, the whole element of starting up and structuring the business properly, it is important that for the business person, you got to begin with the end in mind. The other aspect, when we look at the whole idea of the creation of the business, is the preservation of the business. And this is where As I mentioned, we were looking at the whole aspect of growth and keeping the business growing so that you have a more long-term strategic plan. You were looking at the business being able to provide for the needs of the business, the development of the business with the retain earnings, as well as sufficient is there to look after the needs of the founders of the business. The issues that will be relevant to the person starting the business, and this is more or less a recap, is who will take over the business, who will run that business. And very often in a family-owned business, the hope is that the children or close family member then would look after the business, and that is the aspect of it. The third element which we would come to is the planning for distribution. It can be a very emotional process. And when we went here to the wealth planning chart, one of the things, and I mentioned it briefly last week, when we're looking at the whole aspect of the accumulation of wealth, we're looking around this area here and the preservation of wealth that I spoke on just now, one would automatically assume that the estate planning issue is rightfully placed right here. And then the question would have been, why is the will or the trust so early in the estate planning process? It is actually in the foundation. And that is because very early, and you start to, let me go back. That's because death can occur anytime. And a decision will have to be made about the assets that you acquire. So that the process of estate planning happens all through the lifetime of the person. So it is not good enough, or it really is not safe for a business person to determine, when I have some money, I will then look to address the needs of the estate. We talk about the importance of preserving the estate. You can only pass on what you own, not what you wish you had. It has to be part and parcel of what you have control over. So we recognize that the preservation of the estate is also an important aspect of it, and therefore you must be prepared to set aside money to address those particular needs. If you're not covering the risk of the estate, then you're really not running business. You're really not doing the things that you need to do. And I want to start that at this point. So why is estate planning a whole lot more important than we did before, especially within a business context? And remembering that the business owner is also a family man, in this case, the family-owned business or the micro business, but tend to be in the idea is that there's a family attached to the whole process. When we use Carter's Bakery, for example, and we look at what the daughter reported, in that the parents were able to build a successful business with sustained growth. She had now really, the business is running about 50 employees. People in that business will have loans, they have mortgages. That business is an entity in itself. So the death of the owner doesn't only mean, let's close the business and done with that. There are significant implications to the transition and the succession of that business. But look at the way, and I want to use this as an indication of the thinking that has happened to us as a people. Back in these early years, 1973, when we're looking at one financial instrument, we're looking at mortgages. You could see where the trend has been to move from very low investment in the financials, or choosing investment in the financial system. I should really look at interfacing with the financial system when it comes to acquiring housing, and in business when it comes to acquiring business. The whole development of business. Debt is structured primarily for business, where you borrow, you pay an interest, but if you are selling a product or a good, then you are factoring that into part of the cost, and you're looking at pricing the items or the service you're offering to recover that aspect that you're making the investment in. But you have now where householders themselves progressively more are engaging in debt as a part of their own financial development. This development then brings the question, if I am putting so much money out there and death occurs, how will that be recovered? And it is for this that if you're raising children and you're looking at, apart from the child that you know want to run a business, you don't necessarily know what the child would be. If the business is a professional organization, so you're a doctor or an attorney, and your child doesn't have that leaning towards medicine or law, then what you're looking to get from the business and where you want to preserve it, you're looking to get the cash so that the child can develop themselves into, you know, the kind of person that a parent can be justly proud of. So it really stands to reason that if you're looking at the future and this is part of your estate planning, how do I pass that legacy? It's going to be important then that the child is prepared for the estate, just as, you know, the parent is looking to implement a plan for that child's financial future. It is just as important to prepare the plan. Now, I was asked the question, because I mentioned in all three, and this will be the third time I mentioned this, what if I'm talking about grooming, what aspect of grooming do I think is important in developing the outlook of the child? And let me say to you that it is not just business. The culture has changed. The environment has changed. When we look at the issue with national insurance, and I just want to touch that for a little bit, you would realize that if you listen to the discussion that came with Mr. Osborne, you would realize that he's mentioned about the NIS structure changing from a defined benefit to a defined contribution plan. Wayne touched upon it as well. And what, in essence, that is saying is where the state was responsible for looking after your well-being, more and more the individual will have now to so position themselves that they are looking after their own well-being. The kind of luxuries that we had when planning was not as important, our children will not have that luxury. So if you want to do your child a service, it is important to prepare the child for the future that that child will now have to come into. And it is not just national insurance where you're looking at securing a retirement. For a long time, and let me also add, not only in Barbados, for a long time, companies in North America have been moving away from the kind of plan that guarantees money coming in when you're finished working to the type of plan that only defines how much you will contribute. But at the end of the day, that result is yours. What it meant is that the company is not carrying the risk of the individual. Individual have now to carry the risk for themselves. It has happened in our pension arena. We've seen it happening where government, back in 1975, government decided to restructure the whole government pension. So more and more that is happening. We are raising children and we are doing business and we are living in a world where the luxury of going to QEH and having fast, free healthcare, it is still free, but it really is not fast. More and more, the idea of medical insurance is coming up on the landscape where now that is a cost for care. And it means then that if you're looking at what is coming out of the money that you are having to live on, the retirement income can be reduced because apart from a reduction in national insurance, there are other costs when it comes to healthcare that the individual will have to take on. My contention and my position is that if you are going to raise a child, thinking of the child has to be away from that socialist construct to a more independent capitalist, and not that you don't care, capitalist kind of construct where the child is prepared to take on the responsibility. And to my mind, we are saying we want to preserve our value system. So yes, if I'm grooming a child, how do I now raise a child where I am looking to embed, to create confidence rather than fear? And sometimes the idea of running your own business, or when you don't have a company backing you and you don't have what people consider a safe job, can be scary. Build the confidence into the child. Let the child understand the importance of making the right decisions and the benefit of making good choices. For example, one good idea, as I was thinking through and talking to some parents, and I'm not going to talk about my 7-year-old who runs that I was buying paper from, and maybe I should mention her. She actually had a business selling copy paper, and when I went back to her to buy a ream of paper, the mom said to me, she closed that business, 7 years old, and she opened up another business selling limes and aquarium fish. So, and I mean, that is one that you can see from very early, the child has a mind of business. But as a parent, simple things you can do that enables even a young child to make a choice. If the room is dirty, for example, and you want to say, to the child, you can clean your room by 2 o'clock and we can go to the beach, or you can leave the room dirty and we'll stay at home. What do you want? To my mind, it becomes a way of use of reinforcing confidence, of letting the child understand that there's a reward that comes from making good choices, as opposed to, if you don't clean this room by 2 o'clock, you can get some lashes. The child, what motivates the child is not making a good choice in that positive reinforcement. But what is really driving that child is fear. What we need in business are people who will make a rational, good choice. That in the time of pressure, and if you are thinking about running business, you do have pressure. I grew up in a home of entrepreneurs, and there are times when my dad would come home and he would simply say, I had to pay the guys. There was simply no money for the family because he has a responsibility and a commitment to them. Or you got to be, there are normal things that you got to be managing, so that business is not a cakewalk. It does require serious consideration and contemplation. So the discipline, the understanding to negotiate and deal with people, and that consistency has to be there. And that is the type of character that you want to put in a child. You want to groom that child to take on business. But there's another aspect of business too, and I'm just going to make sure that I did everything right here. I didn't. I've done it now. And I thought I found this clip, and I do think that this doctor says it a whole lot better than me. So just have a listen to the financial aspect of it in terms of how do we prepare the child to see the value of money.
Teaching the child the value of money is a very important life skill. It starts when a child is young enough to understand about money, which is generally about 7 or 8, and they get an allowance. An allowance should be given in 3 parts. There's a part that a child can spend immediately. There's a part that you want the child to put in savings, so they understand saving and delaying gratification. And there's a part that I want a child to give to charity. Giving a gift card that has a limited amount of money, and then letting a child go to the store and having to purchase something within the confines of a gift card is another very good technique for a younger child. As a child gets older in high school, I like a child to be on a clothing allowance, so they learn how to budget a fixed amount of money. At that point, they can learn to have a checking account. They can begin to learn a little investing. What you really want to do is prepare a child when they go out into the world to understand that money has limitations and needs to be managed responsibly.
An important consideration. Let's get back, as in moving away from that. One of the questions I ask clients, especially business owners, is what happens if you died last week? What happens to the business? What happens to the employees? What happens to the family? Because business, is not so easy to shut down a business. So when you are looking at what happens to the business, even if you are self-employed, who signs on the account? And these are things that you want to put in place before death occurs, because it's a whole lot easier to address these matters at the writing of the will, like I often say, than at the reading of the will. But if you look at the business and you look at last week, and why I try to get the client in the frame of mind of thinking about last week is that I don't want to say tomorrow, because the mind is all occupied about what happened. And I don't want the fear to be involved in the process. I need rational thinking to be involved in the process. So do you have some person that can sign that check in the event of death, even if it is a self-employed person? who's the other, who in terms of the bank account. That money will be frozen if there's nobody else to sign. And you also have to watch the bank and the rules of the bank. In some cases, if that person is, if a party to the joint account is disabled or if death has occurred, the account is frozen. So you've got to look at what policy the bank has in place. Some banks in Barbados, you can still go on to write a few checks. Are you taking deposits in terms of like a layaway plan? How are you tracking that? What documentation do you have in place that people will be able to refund it? What projects, what jobs do you have that is partially completed, and how will those jobs how will those jobs be completed? Who are you partnering with that you know, okay, if something happens, there's somebody that can call the person in to know what aspect of the business that you are going to have. The aspect of the business not being completed and somebody being able to come in and know not only who you owe, but who owe you. Those invoices, somebody has to be there to answer those questions, because when death occurs, it is the process of wrapping up the company, wrapping up the estate can be a very emotional and painful one. So you want to make sure you have things in place for that process to be pretty smooth. The question then comes about, how does the family, even if the business is incorporated, and you know, it is really important, and talking to me, we had this discussion earlier, where the concern is you have a number of, you know, single shareholder, one director businesses, and even though our facility allows for that, the business to incorporate like that, there is good merit in having more than one shareholder who can, you know, appoint another director so that the business can continue. But even apart from that, when it comes to signing the checks, who else can go ahead and a signatory to the checks? So there are issues pertaining to the business. How are you going to fund the business if it is going to continue? Are you going to use the money coming out of the business? Is there some sinking fund where you can use cash? And anybody running a business don't want to keep a lot of cash on hand. You want that cash turning over. If you decide, rather than a sinking fund, I'm going to use a life insurance policy, and this is a significant tool that unfortunately, or I shouldn't say unfortunately, more people are recognizing the value of this, even as a life insurance policy creates an immediate estate. We mentioned before about if you have estate as a beneficiary, designation, if you name a beneficiary, cash comes into the family, cash now that can be used to settle the estate. It can be used to pay off creditors. It can be used to restore confidence in the business so that the business can continue. The thing about business, depend upon if that business owner was the key person, that person was not only providing the administrative leadership, but also the skill reside in that business person. It is going to be important to hire people with requisite skills to be able to continue the job, even if you then have another person carrying on the administrative side of it. It might mean at that point in time, you need cash to be able to hire the kind of skill that is needed to get the business going, and also to groom in the management, so that we see where when a business comes to an end, I mentioned the lady with 50 employees who continues that, how does payroll continue? Creditors might be a little, you know, uneasy because they want to be paid. So there's certain elements of business on a whole that you can't get away from. The other aspect that I want to touch quickly on that impacts the business is not only death, is disability. What happens if the business owner was disabled for 2-3 months? Money still has to be paid. There are tools that a business owner can use, unless you say a critical illness plan, and pair that with a medical plan where the cost of recovery can be borne by one financial instrument, and the other financial instrument will bring cash in that even though the medical plan is paying for the medical expenses, covering hospital benefits and things like that. And let me add that the business owner should be clear as to how much money this medical plan is going to protect and preserve. You can't guess at it. The critical illness will bring cash in, and you will bring a lump sum that can then be used to address the needs of creditors, that can keep business going, that will allow other family members to hire the requisite skills, because this now pays a living benefit, and there are certain triggers that can go in to addressing that. The issue for the business owner also comes, this one is a little bit of a headache, where there's a blended family, so that your child might not necessarily be the one that's interested in the business. How then does the stepchild come in and fit into the picture? How do you leave the business for one that wants to continue business, and yet the person that just wants the cash? How then do you structure a plan that facilitates the payment of money out to that person, so they're happy, they get their settlement of the estate so that they can continue pursuing what they're pursuing, and the child that wants to keep that business and is happy doing the business, that business is fully capitalized, that business can continue doing and providing the service that was happening there. It is a whole lot easier to address those issues when you are structuring in terms of the creation and preservation of that. One of the things that I ask people to do is don't let the reading of the will be a surprise. Sit down with the beneficiaries, sit down and have an open discussion. I am going to leave this part of the business because I see the interest is here. Sonny, I'm going to leave you some money because I know where your heart is. So that even when death occurs, there is not no, I wish daddy and daddy should have done this, or mommy should, no, that's not it. Sat down before everybody is on the same page, so that then you can look to address the issues as you need to. I'm going to pause at this point because I really want to leave the time for questioning rather than do too much here at this point. So, Chantal, I will turn back over to you at this stage.
Okay, thank you so much, Roderick. Thank you. Okay, so like Wayne, quite an insightful presentation. And we have some questions here. I think some of them you may have touched on a bit, but can a business ensure its key person to ensure business continuity either after death or disablement?
Yes, and there is a particular insurance package for that, where you can get the tax benefit from it. It becomes important because you are looking at replacing the skills similar to, you know, I don't want to say similar, I shouldn't say similar to the business owner, but a key person, when I talk even of succession, the children may not be interested in the business. You can identify that key person and you can put the legal framework in place so that that person is able to work in the business and money can still come in to fund the members of the family. So the key person is just as vital as the business owner in some cases, and the loss of that person can significantly impact the business. There are also times, and there is a place where you can fund by sell agreements. So you might have a person that wants to buy out in terms of a partnership. This is where you can use, say, life insurance as well to be a significant tool in that type of transaction. So I know I talked with the key person, that main person that keeps the business going. You really don't want, you know, that the loss of that person. It's hard to replace that because of the unique skill that that person brings, or the partner who might also be a key person. You can use life insurance in those cases to address the needs that you know would be left in the event of that.
Okay, thank you. Is estate planning important for small business owners?
Yes, it is, because there's a nice thing about estate planning. The idea of the business was to generate money. That was key. To look after your family, that was key. While the business is growing, you know, you talk about while the grass is growing, the horse is starving. This is where you can use, life insurance, and it has to do with the type of life insurance you may choose to use. Where for a small premium, you can have the kind of money that in the event of death will wrap up the business. It will send the child to school. It will continue to look after the rest of the family. So what you could not do that you were looking to earn earnings from the business, this product, that life insurance product, is now what you will use in order to definitely provide for family. So yes, small businesses, it is important, but I also know that sometimes a small business, there's a choice. You want to buy stock, you want to pay certain stuff, and I don't feel I have enough money to do it. So for the small business, what I say, if you want to sacrifice anything, sacrifice money set aside for retirement. But don't sacrifice money set aside to protect risks. It is too much. So when I run a small business, and I sometimes don't like to use myself as an example, because my life is different. You've got children, your 3 children, a good mom. I am concerned that I needed to have money for my children. So if it is one thing that I made sure got paid was the life insurance, because that was $500,000 sitting down there to look after them. So I was not looking at the $150 in premium. What I saw at the end of the month, if I don't pay that, I am making a $500,000 decision, not a $150 decision. So the choice became easy. You see, obviously, why I don't want to pay more than $150 and I use a particular type of insurance is because I still got to buy the books, I still got to buy the school plus, because it becomes a balancing act. Now that the children big, you know that they're not beneficiaries on the policy. I got to change it so that I can address the issues that I need to address. But very young children, early in the business, you don't want to play with it. It is not $100, it is not $200, it is $500,000, it is $1 million. You got to look at what is the true worth of the product. So I'll answer that way.
All right, thank you. Okay, so you spoke about grooming the children. What if you groom the children and they do not want any part of the business?
No problem. You can sell the business. You see, it can go in some cases as a going concern. There are people you can, like I mentioned before, there are employees, and kind of in the nature of the business, there are employees that you, if you're incorporated, you can offer shares. And a number of even big businesses are doing that, where they're offering shares in the business, but the key person is working and developing the business themselves, and the family then can get the benefit from the money that comes in, at that time. So it's just a case of how you restructure the business, whether it be employees, if it is a professional entity, you can look at partnering really early, and then the partner then can look at buying it out so that the family still can benefit from it. So yeah, the children may not be interested in it, and it happens often.
Okay. Estate planning appears to be something that is expensive. So do you require having life insurance before speaking to an attorney, or speaking to an attorney and then having life insurance?
I would go life insurance really early. I think the story is well known of I was trying to Walt Disney that pulled from the life insurance policies. And there's actually one guy who said to me he got $7 million of insurance. The man is a businessman. And when he said to me, I did think that the management and staff of the insurance company probably on a prayer list. I hope he would not die. Not that we wouldn't pay out. Yes, we will pay out the claim. But for a man that has substance and wealth, I could not believe that this man needs the insurance. And so it is something, once you've got children, once you've got responsibility, once you've got debt, then you got to be a responsible person. Understand and ask yourself the question, if I died last week, what's going to happen to them? And, I've had some cases where and I mean, I know I'm speaking to a Barbadian audience, so I don't want to use examples that would, highlight to anybody, because I mean, this is a small society. But it is hard for a woman to be left with children. when you could have simply invested in a small insurance policy and leave something for your family. So before you go to a lawyer or anything and you're carrying risk, go by the policies. It's not a problem. I'll answer it later.
I'd like to add a little bit there to that question, if that's possible. Estate planning is about asking yourself, what do you want to happen? So even before you start thinking about a life insurance policy or a lawyer, these children or this spouse or my parents, what do I want to happen when I die? What provisions do I want to make for them? When you can answer those questions, then you can figure out if you need life insurance or if you have enough assets to make your wishes come true. And then you're speaking to a lawyer because when you're dead, your words have no meaning anymore unless they're down in writing in a particular format. This is where lawyers come in. When you're thinking about how much money you need and how much money you might need to make your wishes come true, a planner comes in to help you figure out how much money you're talking about. Then we look and see if that money is available. If that money is not available in your assets and your savings and so on, then you might need something like a life insurance product that creates money on the event of your death. As Roger says, how that works is you, in exchange for a small little bit of money every month, the insurance company says, at your death, we'll pay out this large sum of money to whoever you tell us to pay it out to. So don't think in terms of a lawyer or insurance, think in terms of what do I want to happen? And then what will it take to make it happen for my loved ones?
Thank you, Wayne. Thank you. I just want to remind the audience that you guys are invited. We want the session to be interactive. So if you have any questions to pose, you can raise your hand or type in the chat, whatever is your preference. We have another question. So can a life insurance policy be estate creation?
Well, your estate is everything that you own. Life insurance is peculiar because you own a contract. That contract says in the event of your death, the insurance company will pay this large sum of money to the beneficiary that you've identified. So having $1 million policy does not make you a millionaire. Your estate isn't worth $1 million. Your death is worth $1 million to somebody. But that's what the curious thing about life insurance. It stands outside your estate. If you have a house that is free and clear, that you own all by yourself, and it's worth $1 million, you can say your estate is worth at least $1 million because you have an asset that is part of your estate. It is something that you own that is worth $1 million, but not necessarily life insurance policy. The most a life insurance policy is worth is what you can surrender it for in cash. So you might have a life insurance policy, you've had it for 10 years. It has a cash surrender value of $10,000. That means is this contract is worth $10,000 if you turn it back into the insurance company. The face value might say $1 million, but it's not worth $1 million. Your death is worth $1 million to the beneficiaries. Not an excuse for them to bump you off, but that's just how the contract is structured.
Thank you, Wayne. Okay, so hiring an attorney is expensive. Can I do it on my own?
Doing what? I don't know particular. The person doesn't say it. I know QCs that will charge $300 for creating a will. And I asked why, and the rationale was, we want you to feel free to come back and make changes to your will. So we don't want it to be exorbitant. Here's the curious thing, however. Attorneys don't normally talk about how much it will cost to administer and distribute your estate. Because after all, if you walk into an attorney and say, I want to have a will drawn up, when the time comes for that will to be administered and probated and distributed, you're dead. So you're not footing that bill. So normally don't have the discussion with you. But for us as planners, we want to know how much is that likely to cost to make the provisions so that when the time comes, your will be carried out. So don't necessarily think that hiring a planner or hiring an attorney is expensive. I always say ask the question first and then make the decision afterwards.
Understood. Thank you. Okay, so what about investments that what about an investment that earns a higher return than insurance? There's not a discussion outside of life insurance when there are other options that may yield results in a higher return on investment.
Yeah, I saw that question.
Yeah, that's what last week.
I want to answer that bit, but before I do, why I interjected here too. We mentioned about the trust, which I think it is important. It is not an instrument that a lot of Barbadians use when it comes to the trust, but it is one that I am hoping more and more people will start to utilize. Because if you set up a trust, and this is not you have a testamentary trust that can work. So you can go to a company, a corporate trust, you can go get the facilities put in place, and the funding of that trust will occur upon death. So it doesn't cost you anything to put the facilities in place. But what it does is that it allows you to manage the assets of the children. Like Graham mentioned before, of the minors, it can look after business, you can put land. There are a number of things that then you can do to ensure that there's proper supervision of the assets. Why it becomes critical is that sometimes you need to protect people from themselves. And I've seen it all too often where the person gets the money and in short order the money disappears. And even if you leave the money within a will or you leave the assets in a will, there are certain habits that this person might be, drug habits that that the person find that addiction happening, and the money goes in a hurry. It is really sad. So I want to really underscore that you can have the trust, but also if you are going to look the idea of having a trust and you're going to use a corporate trust, then we're looking at starting about $500,000. $100,000 will not do it because there are fees that can be quite high. The income from the trust, you will find that income is taxed at a higher level. I think it is around 40% last time I checked. But in Barbados, if you are the setter or the grantor of the trust and you are still alive to the individual trust, there's an amendment to our act that even if you put a trustee in place, you still have a voice as to what will happen to those assets and how the investments are going, which is not generally the way the trust is set up, but it has been a provision made in our laws, and the rationale for that was given is seeing that you want investors come to Barbados and establish a trust, and they don't really know, the persons on island where the trust is resident. Then you want to still give those investors enough confidence that they will have a say. But so that provision does make a significant difference. I know to go on the question about investments, you can't compare investments with insurance. They're two different instruments for two different purposes. You're using money to earn money on the investment, and it has a certain level of risk. When you're talking about when you're looking at insurance, you're using money for protection. The money on the insurance comes in the event of death to look after needs, but you're not looking to generate earnings or growth from the insurance product. You are leaving sufficient cash in hand to make safe investments. But when you are talking investment, you're talking risk. Even if it is what was very safe government bonds, once you're talking investments, you're talking risk. And we lost $1 billion from national insurance, which I'm really not happy with in that regard. We know when it comes to crypto, we got issues. We know when it comes to investment in companies, share price fluctuate, mutual funds, share prices will fluctuate. So yes, investments are key when it comes to earning money. The business owner, he's making an investment in his business, but it is a completely different instrument than the insurance. The purpose is different. So I can answer it that way. Go ahead, Wayne, and I'm going to.
Right. I think last week what happened, we mentioned certain types of insurance products that can be viewed as an investment in a narrow sense. Remember, we talked about endowment policies. So we said that this is a policy that is like term insurance with cash back at the end of the term. And we could see what the investment component was, and then determine what the rate of return was. And we also said that it didn't have market risk because the contract says you will, at age 65, you will get $100,000 or whatever it says. It isn't like an investment in the traditional sense, in that we all know if you stop making those monthly payments, premium payments, this policy would lapse and you would lose everything. Like an investment where you invest $100 every month in mutual funds, if you stop for a year, you don't lose what you've already invested per se. That is still there, growing, hopefully. So in a narrow sense, some life insurance policies can be viewed as an investment vehicle, and some jurisdictions they actually are, in the UK, Australia, and so on.
Yeah.
They're viewed as investment products, so you need to be able to license the advice on those investment products. But the person who asked the question is right. There are other ways to generate income.
Correct.
Of course, all those ways carry some form of market risk. So I don't think we give the impression, or we sought to give the impression in any three of these sessions, that insurance was the one and only way to invest money, because very often it is one of the poorest ways to have some sort of return on the money that you park with every month.
Yeah, it's safe. It's safe in that regard. Chantal, let's turn back over to you.
Yes, thank you, guys. Thank you. Yes, I just wanted to add that the discussion can go on, and it can go on forever. We have one more question and then we will wrap up. If you guys do have any further questions, we will leave the contact information for both Roderick and Wayne, so you can contact them at a later date to discuss anything that you wish to discuss personally. The final question asks, as a small entrepreneur in the creative sector where most of the money made is seasonal, are there other types of products or ways that I can employ to plan for my estate?
Repeat the question again, sorry.
That's okay. As a small entrepreneur in the creative sector where most of the money made is seasonal, are there other types of products or ways I can employ to plan for my estate?
For the business owner, the bulk of your earnings will come from the business, and that is why in estate planning you're looking at the creation and the preservation. So you want to look at how do you manage that money over the times when in the lean months. So it does call for some management, and how do you invest that money where you can get returns. The business owner will not make money from just trying to hedge against risk. The nature of a business owner is that, or say you're not making money by having a deposit, say in the bank or credit union or something like that. The nature of the business owner is that you don't want to get 5% or 10% on your money or on the effort that you're putting in. You're looking at getting $1 and multiplying it. So you want $2, $3 coming back. So when it is seasonal and the going is good, then you have to take that money. It will require careful management in order to get the returns. That is what the nature of the business, what you're doing. But yes, it does have the risk of dying is what will impact the responsibility of the business person. And then that is the risk by which then you use insurance, because you can't use a sinking fund. You can't use just money you have there sitting down. Simply will not be enough. because that is where you use the instrument to deal with that in your estate planning. But the business in itself, and I can agree with what I saw Tyrone put in, the business in itself is the estate. That is what is in the cash.
Okay. Thank you, Roderick. Thank you. So we have this evening's proceedings have now come to an end. It also is the end of our 3-part virtual discussion series on financial planning. Over the last 3 weeks, we covered financial planning in the home for the business, retirement planning, and this week was estate planning. If you guys have any further questions, anything else you would like to discuss personally, I will leave Roderick's number as well as Wayne's. So Roderick's contact information is 850-3410, 850-3410. And Wayne Eiffel's number is 850-6863, 850-6863. I want to thank everyone who has been a part of this discussion series over the last 3 weeks. Thanks for your support. Thank you for showing up, and we look forward to seeing you in our next 3-part virtual discussion series. Thank you so much.
You're very welcome.
Have a good evening.